Good afternoon, ladies and gentlemen, and welcome to the Q4 FY22 earnings conference call of Pondy Oxides and Chemicals Limited, hosted by AlphaStreet. This is Radhakrishnan Chonat from AlphaStreet, and it's a pleasure to host Pondy Oxides and Chemicals Limited for their quarterly earnings results conference call. From the management, we have Mr. Ashish Bansal, Managing Director of the company, Mr. K. Kumaravel, Director of Finance and Company Secretary, and Mr. Piyush Dhawan, Vice President of Commercial. May I now request Mr. Ashish Bansal to take you through the presentation, and post that we can start with the Q&A session. Over to you, Mr. Ashish.
Good afternoon, everyone. This is Ashish Bansal here, Managing Director of Pondy Oxides and Chemicals Limited. We wish you a very warm welcome to POCL's Q4 FY21-22 earnings. I hope that you and your families are keeping safe and are in good health. POCL has delivered a historical annual result with a growth rate of 45% year-on-year and 33% on a quarter to previous quarter year basis on top line, and has delivered an EBITDA of 81.79 crores for the financial year 2022 versus an INR of 26.68 crores the previous financial year, showcasing a growth rate of 207% on a year-on-year basis. We have achieved an all-time highest top line of 1,455 crores versus INR of 1,004 crores the previous year. We are happy to share that we have crossed a turnover of $100 million in exports for the financial year 2021-22. The future outlook of the industry remains relatively positive. POCL has recommended a dividend of 50% this year versus 25% last year, and it continues to be a consistent dividend paying company since the inception. POCL is bullish about recycling and its future, and it believes that India will continue to be an emerging market. To factor in an accelerated entry into associated verticals, as was mentioned in the previous earnings call, we have incorporated a subsidiary of our company, that is POCL Future Tech Private Limited, which will enter into segments like plastics, from where we will be using our in-house and other industrial plastics, e-waste, lithium-ion recycling, rubber, oil, glass, paper, and other value-added products, along with mergers and acquisitions, and also set up of an R&D lab for commercialization, such that the investments are realized with a faster payback period under the umbrella of POCL Group, based on such opportunities available. During Q4, there was a visible volatility in the market. We cannot ignore the fact that Russia-Ukraine war has affected the oil prices, currency, and disrupted the overall supply chain network. On a high level, it is to be noted that there are direct correlations with the commodities in metals. Raw materials and additives for us, which affect the sentiments of the market as a whole, and also impact the cost of manufacturing. COVID is still prominent in many countries like Korea, Japan, Thailand, China, and is slowly transitioning, hopefully, to dormancy. In India, the inflation is also relatively higher and bears the impact on purchasing power of individuals and companies. The government of India is taking necessary steps through the Reserve Bank of India to monitor and control the depletion of the rupee value and inflation. Sustainability of the results will be our focus in the coming quarters to withstand macroeconomic factors that are currently affecting the entire economy and the industry, not only restricted to non-ferrous metals and recycling alone. Diversification of portfolio non-ferrous metals and other products will be a focus in the coming years. Our collaboration with Ace Green Recycling is significant. The technology is futuristic since the recycling process is for used lead-acid batteries that release no greenhouse gas emission. POCL is the first company in the manufacturing space to adopt this technology in the recycling process used for lead-acid batteries to manufacture lead ingots. 2022-23 will remain significant in many aspects. We will set the tone for our vision till 2026 for the company. POCL will continue to look into other sectors with stronger EBITDA margins, as well as grow as our present portfolio capacity. We would continue to concentrate on value-added and specialized alloys that give us incremental margins. POCL would continue capitalizing the first move advantage of India's first 3N7 lead brand to be registered on the London Metal Exchange, and add a few other feathers to the cap in this financial year. We are happy that our peers in the industry also have been empaneled in MCX and such reputed exchanges. This will help the industry as a whole to get more and more matured in the upcoming years. We also focus on creation of yards for collection of non-ferrous scrap in the coming years to leverage on better rates in procurement as a strategy to enter into other segments as well as stretch our geographies. Our relationships with our customers and suppliers continue to remain strong, which bears testimonial to the fact that we have supreme brand image within the lead sector, known for quality, high level of efficiency, reliability, technical support and service. Through extended producer responsibility and batteries management and handling rules, the government is focusing on recyclers and dealers to tie up with OEMs for bringing back the batteries into organized sector. Through these developments, we expect to see an improvement in both domestic and organized collection of scrap. Our robust procurement strategy is paying off well to ensure fulfillment of production capacities in times of such volatility. In addition, we continue to monitor our hedging strategies closely in a volatile commodity market. I express my sincere thanks and gratitude to all the shareholders and stakeholders on behalf of POCL for having faith in us in the last financial year, and we will continue to steer your company in reaching greater heights. Now I'll hand over to Mr. Kumaravel, who will run us through the financials of POCL. Mr. Kumaravel.
Thank you, Mr. Ashish. Good afternoon, everyone. This is K. Kumaravel, Director Finance and Company Secretary of POCL. We have already shared Q4 March 22 quarterly and annual results on the BSE with yourselves, and now I would like to summarize the same for easy reference. We have continued to deliver a healthy performance despite the challenging market conditions. Our revenue from operations for Q4 was rupees 397.06 crore versus rupees 298.45 crore for the same quarter previous year, depicting a growth rate of 33%. The quarter-on-quarter basis, our growth rate was -3% for the entire financial year. The earnings before tax grew by 367%, EBITDA by 207%, and the EBIT by 298%. The earning before tax for Q4 was rupees 12.57 crores versus 5.29 crore for the same quarter previous year, showing a growth rate of 138%. However, on quarter-to-quarter basis, there is a decline of earnings to 19.89 crore. There has been a phenomenal growth of EPS by 348% from INR 18.54 to 83.01 rupees. It is to be noted that rupees 11.75 crore worth of exports were completed as on 31st March 2022 with the bill of lading pending. As per the relevant accounting standards and principle, revenue recognition, the same will be booked in the financial year 2023. In addition, such inventory has also been valued at cost as per the Ind AS requirement. To have a deeper insight of the profitability, there has been an increase in cost of additives like smelting additives like coal, soda ash, cast iron, furnace oil have substantially increased. Similarly, the refining additives like caustic soda, sodium nitrate, and RGS powder have also likewise increased. The macro and microeconomics have been challenging for all the stakeholders, but this is part of the business cycle. There has been a significant price increase in the cost of smelting, refining, ocean freight, and utilities like power and fuel, which further add to the overall cost of production. However, this will be further backed by an incremental increase in the premiums, which will be passed on to the customer during commercial discussions and market conditions this year. The proportion of revenue from operations for the financial year 22 is 54% from exports and 46% from domestic, versus 50% each last financial year. On the sourcing of primary raw materials for the full year, the proportion of imports versus domestic procurement is 77% imports and 23% domestic. We are continuing to increase the domestic supplier base as well. On the volume side, lead quantities have increased by 18% in financial year 2022 versus 2021. That is 69,518 tons produced against the production of 58,613 tons in the previous year. The same has also been increased by 18% for the same quarter previous year, and it is even increased by 0.1% on quarter-to-quarter basis between Q4 and Q3. For crucial ratios, we are happy to share that the return on assets have improved to 23.88% versus 7.46% in the previous financial year. Return on net worth to 26.18% versus 6.91% in the previous financial year. Return on capital employed is 23.09% versus 5.96% only in the previous financial year. Debt to equity ratio improved to 0.12% 0.12 to 0.04 in financial year 2022. Fixed asset turnover has improved from 19.61 in previous financial year to 27.99 times. As mentioned by Mr. Ashish, we have also incorporated a subsidiary company, that is POCL Future Tech Private Limited, which will enter into a new verticals. The company will capitalize on the tax incentive which are available for new incorporated companies, which in turn will pass on to the shareholders and provide synergy to the parent company. POCL's business model is based on its robust business-like profile, which is reinforced by well-established connections with the customers, a diverse procurement and supply base, moderate entry hurdles, and proven manufacturing capabilities. It is to be noted that POCL is a consistently and valuable dividend-paying company from the date of incorporation. The board has recommended a dividend of 50% in the current year. The company has retained the profits to invest in other verticals, which will benefit the shareholders in a larger picture. The trend in profitability should remain positive and consistent like financial year 2022, as we remain optimistic and prepared for any market volatility and economic factors. Our industry's future outlook is quite bright. The lead business will grow at a CAGR of 20%, and now that we have added to copper and zinc to our portfolio, we plan to increase the same portfolio in the coming financial year. We want to place a specific focus on lead business as it remains our primary strength by enhancing the operational processes and adding innovative production processes for a sustainable and green environment. Now I will hand over to Mr. Piyush, who will run us through the overview of operations and commercials. Over to Mr. Piyush.
Thank you, Mr. Kumaravel. Good afternoon, everyone, and welcome to the earnings call. Myself, Piyush Dhawan, VP Commercial for POCL. I'll be briefing you on the operations and the commercial update. We are happy to mention that POCL has received the Top Out Exporter Award for the year 2019, Gold Trophy from EEPC India. Further on, for the year 2018, we have received the Top Star Export House in Southern Region, Gold Award from the Federation of Indian Export Organizations. We are also pleased to announce that we have crossed a turnover of $100 million in exports in Q4, and accordingly we'll have the 3-star export house status shortly. Firstly, I would start by reporting on the updates from the previous earnings call. We have completed the exercise on operational efficiencies, and we will be setting up the KPIs, the key performance indicators, and further see the translation of such efficiencies in the coming quarters. We have seen an improvement in the yield, which will be reflecting in our results in the ensuing quarters as well, to offset the cost of increase of raw materials, which has been highlighted. At the same time, there were preventive maintenance drills done for our furnaces, and we will be going live with a new furnace tentatively in June next month. As committed, we will come back and substantiate both in values and quantities the operational efficiencies on realization of the same. We also intend to initiate an IoT platform in the factory operations by interfacing with the machineries to realize the operational efficiency along with the implementation of the ERP, which was mentioned in the previous earnings call. Last time, all of us were briefed on the lead recycling process. In the coming months, in addition of new segments, we will and intend to walk you through the processes for the same, for an understanding of what we do actually and transpire the same to our stakeholders. Our focus this year will be to utilize the capacities effectively. Our capacities of lead has now increased to 132,000 metric tons per annum. We see a calculated approach in choosing the optimum mix of raw materials for refining this year. In view of the Ukraine and Russia war affecting economies across the globe, there is an inherent effect on various parameters like pricing of raw materials, and obviously no industry is immune to the same. However, we are mindful of it and are taking all necessary steps to ensure that we withstand the same. For all alloys and pure lead, the export market is continuing to grow at a CAGR of 18% to 20% in terms of quantity. Some of the contracts that have been renewed so far endorse the same. Also, there has been an affiliation with the BSI for Environmental Management System, and we would be targeting important affiliations with prominent agencies for a first mover advantage to set a portfolio of certifications and registrations with distinguished agencies worldwide. In continuation of our expansion strategy, we would like to update you on the operational front of our collaboration with Ace Green Recycling and also formation of the subsidiary POCL Future Tech. On the Ace Green Recycling front, we'll be going live with 2 modules initially with a capacity of 1200 tons per annum as a starter in the Andhra plant by Q3 in 2023. The salient features of the agreement with Ace are zero emission lead battery recycling technology operating at room temperature, reducing the carbon footprint on a global scale and preventing the emission of GHG, greenhouse gases. We'll be proceeding with getting the consents and approvals from the Pollution Control Board and are now setting up the operational modus operandi. Further, we'll be looking at how we can earn carbon credits through the process. There has been a tremendous amount of research, project analysis and efforts gone on to adding to our portfolio of offerings in plastics, e-waste, rubber recycling, lithium ion and other non-ferrous metals. Based on the upcoming opportunities, we would see some positive headway into the aforementioned products. Recycling is something which the company is synonymous with, and we will continue to focus on such segments. The progress will be visible in the upcoming quarters for plastics, non-ferrous segment, and some other verticals. We are doing a lot of internal exercises with respect to brand architecture, ingraining core values, in-house training, R&D of specialized alloys, grooming and investing in talent and creating a pool for the same. Operational efficiency remains a focus. Inculcating the concept of cost savings and cost avoidance will remain part of the core values as well. There has been a lot of focus and concentration on preparation of an investor presentation, which will be transpired to the shareholders shortly, as we want to translate all the R&D into a project in the coming years through the presentation. We have completed the project R&D and evaluation stages and will see positive progress and movements in the coming months. Obviously, this is a forward-looking statement subject to market opportunities. POCL is now walking the talk on circular economy and green technology through its collaboration with ACE and basically incorporating a futuristic approach in a future tech company of creating verticals to eventually become the flag bearer of circular economy globally. That is all from my end. Over to you, RC.
Thank you, Piyush. We'll now move into our question and answer session. Today, we have participants joining via Zoom video platform and also via our telecalling platform. Participants who have joined us and connected with us through Zoom video platform can also post their questions directly to me on the chat box, and we'll ask the question on your behalf. Alternatively, if you wish to ask a question directly, please use the raise hand functionality. I will initially take a few questions from the chat box as well as questions we have received via email, and then we'll open it up for the participants to ask questions directly. I'll wait a few moments. I'll start with the questions that we received via email. What growth percent the company aims for in the current fiscal in regards to EBITDA, and what is the OPM percentage?
I answer this question. Taking into account the current macroeconomic factors and the inflationary trend, we are expecting the EBITDA margin of 6 to 6.5% and operating margin of 11 to 12% in the current year. This is a forward-looking statement and not restricted to these numbers alone. Though the operational efficiencies, we can see a positive effect to the aforementioned numbers.
Thank you, Mr. Kumaravel. The next question is, what is the dividend payout policy for the company?
We acknowledge that there is no such dividend policy currently in the company. It is to be noted that our board, while recommending the dividend, considers various factors like cash flow, necessity for conserving the resources for future deployment, adding expansions and the growth, which in turn will generate a futuristic value creation for the stakeholders, reducing the burden of debt and inherently creating a stronger base for the coming years. However, as a matter of good management practice and futuristic approach, we have intentions to frame the same in the coming years.
Thank you. The next question. Is management planning to list the company in NSE in the current fiscal year? If not, what are the reasons?
Yeah, of course, in view of our recent interactions with the shareholders and the investors and other stakeholders, analysts, and pursuant to our previous earning calls, our futuristic growth of the company and taking into account the value creation for the shareholders, the board is evaluating the various obligatory requirement to list the shares in the NSE. And once the decision is reached, the requisite intimation will be given.
Thank you. The next question. What are the projects in the pipeline for the year?
Okay, so I'll take that question since it's regarding to projects. We have done substantial research. We've already mentioned that. A lot of project evaluations have been done in the recent months, and a lot of effort has gone into analyzing various verticals, like we mentioned in plastics, other non-ferrous metals, e-waste, rubber recycling, and lithium-ion as well. Now, based on such upcoming opportunities, we kind of see some positive headway into such products in the coming years, maybe months. This is part of the vision of the company and the futuristic outlook, which will be shared by the investor presentation shortly.
Thank you, Piyush. The next question is, what has been the impact of Russia-Ukraine conflict on the company and lead industry in general?
Let me take this one. As you are all aware, the Ukraine and Russia war has had a huge impact on the oil and gas prices. There has been massive currency volatility, and the broader supply chain network has been impacted badly. On a high level, it's worth noting that there are clear relationships between metals, raw materials, and additives for us, which influence market sentiment and manufacturing costs. There is visible volatility in metals, which all of us are noticing, and that applies to our segment in non-ferrous as well. However, there has been a marginal impact on lead sector as the region, Russia or Ukraine, are not large producers of the metal. They are more concentrated towards nickel, oil, and gas. Hence, the impact has been indirectly felt only in the costing of our processes due to increase in price of oil, freights, and other allied services. Yeah.
Thank you, Mr. Ashish. I have a question from chat from Mr. Sachin Abhyankar. Please explain quarter-over-quarter dip in profitability and if any one-off expenses in Q4.
Could you repeat the question once again?
Please explain QOQ dip in profitability and if any one-off expenses in Q4. There is an additional question from Sachin himself. Also, in absence of major capex, why the dividend payout is so low?
Yeah, if you take the finance cost, for example, I take it. In average capital, utilization of funds is in Q1 it is 109 crore, and in Q2 165 crore, and Q3 it is 145 crore, and Q4 it is 98 crore. So average my interest payout for the whole year is 8.45 crore as mentioned in the quarterly results and the annual results. So our effective rate of interest is around 6% or 5.9% it is coming. This is on account of interest payout for the whole financial year. If you take the profitability almost similar to all the quarters except the last quarter. Always it is a balancing figure between the last 3 quarters and the audited results. Otherwise, it is similar in almost in all the quarter in terms of turnover and profitability.
Thank you, Mr. Kumaravel. Now I'm going to open it up for the participants to ask questions directly. Please, once again, use the raise hand functionality to let us know of your interest. I'll call out your name and unmute the participant. Please announce your company affiliation before asking the question. And the first question is from Mr. Vaibhav Badjatya. Mr. Vaibhav, please go ahead.
Can you hear me?
Yes.
Yes.
Yeah, thanks a lot for providing the opportunity. So I just have 4 questions, so I will just ask them together. If you can reply one by one, that would be really helpful. So first is that I want to know our capacity in metric terms separately between refining and smelting. So I'm sure our capacity might be different for both the operations. So just wanted to know a separate number for both the things separately. That's question number 1. Secondly, for importing scrap, what is the quantity of import license that is available to us, and what is the timeline and process for revising those quantity whenever we want to revise it? So how much time and what is the process that it takes? That's second question. Third, there has been talk from the EU front that they are going to ban all the export of scrap. Fortunately, it has not happened yet, but there has been increasing voice within EU for that. So just wanted to know what is our imports from UK and from non-UK EU countries. If you can just give the separate numbers. And fourth, last quarter you have said that the improvement in margin is because of scaling of our smelting capacity. So just wanted to clarify, is it MMPL smelting capacity scale up or there are some other unit which has scaled up? And consequently, what is potential scale up that is still available to us in MMPL, which has now been merged? So these are the 4 questions. Great if you can answer them point by point.
Thank you, Vaibhav, for the questions. So what I'll do is I'll take the first and the 4th question, and then second and third probably we'll just you can rephrase it again so that we can answer.
Sure.
The first one was regarding the capacities. So for the record, we'll just distribute the capacities. Right now for lead, we have a finished goods capacity of 132,000 tons per annum. In terms of smelting, which we kind of mentioned last time, that's an integrated process as well. For that, we have a capacity of 96,000 tons per annum. Coming to copper, the standard capacity is 30,000 tons per annum, and then since we have zinc also as part of the portfolio, there we have a capacity of 12,600 tons per annum. Coming to your 4th question, where you mentioned on the fact that is it possible to scale up your capacities? So the answer is yes, there is a possibility to scale up capacities, but it kind of works on various permutation and combinations. Smelting and refining again goes hand in hand, also based on the availability of raw material. So we do a lot of strategy in terms of procurement of raw material to find the correct mix for refining. So that is how it kind of works. So that's basically your 1st and 4th question. Could you please rephrase question 2 and question 3 for us?
Yeah, sure.
One to add on to Mr. Piyush's answer, this reflected during the current year 21-22 itself, there is a growth in 20% capacity utilization over the previous year.
Correct.
We mentioned in my talk also quantity produced, how much is in 2021 and 21-22. 20% higher utilization shown in during even COVID years also.
Yeah, so I think the volume that you mentioned was around 70,000 for the lead.
Yeah.
So refining is still quite underutilized, and I'm assuming that we can I think the optimal would be around 80% utilization. Is it practically possible to reach 80%?
Yes, it's practically possible. Yes.
Okay, got it. And my 4th question, which was on MMPL, because last quarter you said that there was margin improvement because our smelting utilization went up. So was the merged MMPL primarily a smelting unit or it was a refining unit?
So MMPL was a completely integrated unit with smelting and refining both available.
Okay.
And the increase in smelting capacity was made in both the units in the last financial year partly.
Okay, understood. So now, please go ahead.
Yes, sir. Yeah, I'm done. You can.
Okay. So on the rest 2 questions.
Yeah, question 2 and 3 basically, I think those were missing.
Yeah. So question number 2 was around our quantity that we are eligible for import under import license. And if you want to increase the quantity, then how much time it takes to get the revised license? And that's what I wanted to know. That's question number 3.
For second unit. The MOEF, other one is 30?
130, 136.
So for both the units combined, we have approximate capacity of close to 90,000 metric tons where we can import in little excess of 90,000 metric tons that we can import.
And to revise this and increase this, isn't process very cumbersome and lengthy, or how much time?
Basically, how currently MOEF is looking at is they're looking at the past 3 to 4 years, 5 years of your production, sales, and your actual performance in terms of export and all of it. So as we are growing year on year, we get that incremental chance to get higher license capacities. But this would be difficult for a new entrant to get an import license because they'll have to first show a track record of 3 to 5 years to get a fresh license.
Got it. Understand. And lastly, on the 4th question, so the EU recently has a lot of time. There has been talks around that EU wants to ban all this scrap exports and want to recycle it within EU itself. Fortunately, it has not happened yet, but there has been increasing talks around that. So just wanted to know, if it happens, then what would be our alternates? And secondly, what is the breakup of imports from UK and from other non-EU countries? Because if it happens, I don't think so it will be applicable to UK.
Specifically from UK, we import say about maybe maximum of about 7 to 8% of our requirement and not too high.
Okay.
So, I mean, and in our current years, as we have also mentioned in our last earnings call, we are setting up our complete network even domestically, where we are slowly increasing our domestic procurement. And also we are trying to procure more from countries which are closer to India to reduce the risk of, these kind of logistical and other supply chain issues that are rising. So I mean, a 7 to 8% shift, I don't think should make a impact currently as we see.
Right. But that's only from UK. From other non-UK EU countries.
See, UK and EU, I'll say another 7-8% from EU all over. So UK and EU will contribute in tops to tops about 15% of our import of raw material. And which is, it has been tapering over. In fact, it was much higher about 4 or 5 years back. But over the last few years, we've been slowly tapering from there, and we are concentrating more on domestic, trying to increase our domestic and also countries nearby where it's more possible to import.
Got it. But I think that was helpful. I was under the impression that our sourcing might be much higher from the EU.
No.
But that's quite helpful that you've clarified that. But that's it from my side. These are the questions.
Thank you, Mr. Vaibhav.
Thank you, Vaibhav. The next question is from the line of Karan Asli from Maximal Capital. Karan, go ahead.
Hello. Yeah, hi. Can you hear me?
Yes, go ahead, please.
Yes, we can.
Yeah. Thanks for the opportunity and congrats on a great Q4 and FY22. Couple of questions for me. In Q4, if you could help me out with the revenue and the volumes across lead, zinc, and copper.
Okay. Any other question?
Right. So this was the first, and second is if you could even help me out with the EBITDA per ton that we have seen across these 3 divisions, and what is the expectation of this going ahead. So yeah, if you can answer these, then I can take up further.
Just give us a couple of seconds.
Sure. Right. So in the meanwhile, I can probably ask another question. Okay, go ahead.
Yes, we have.
Yeah, as in my talk, I informed the total quantity produced for the year. 69,000 tons we manufactured.
Close to
70,000 tons we manufactured. And it is almost equal in all the quarter.
Can give the numbers.
Right, sir. And so there was no material production in zinc and copper? Was
We
this?
produced copper, we produced around 255 tons during the year 21-22.
Each quarter. This one and last quarter is more.
Yeah.
So basically, like I said earlier, also copper, we are still not taken up by capacities because we are looking into specific products, and we are still looking into what products to finally zero down on. So we are still on our initial capacities of approximately 250 tons only.
Understood. And by when would you expect this division to materially start contributing? Could we see some good traction in FY23?
Yeah, we are looking at the Q4 of this year is when Q3, Q4, when we will be able to stabilize, and then thereon we look into the growth of that unit.
Okay, understood, sir. And about this Ace Green tie-up, I think we have a licensing deal of 12 million. So is this 12 million the absolute amount, or is there any production-linked payments as well, implying that higher production would lead to an higher outflow? So if you could just sort of give some color on that.
Yes, definitely. 12 million is on the current date is the absolute number in terms of procurement of the equipment, machine technology and all of those, which will be in phased manner. Like initially, we'll be splitting that into 3 phases. And as the modules get commissioned and on success of the first phase is when the second phase will start kicking in. So after the first phase, the pace of installation of those modules on success will be at a higher rate. So we will have a clear production and the success of these modules by Q3, that is by December. We'll have the complete outputs and we'll have the numbers in terms of, what is the production final numbers, cost, and how we are going to scale it up. So the initial modules are being installed approximately in the month of September and will be commercially producing by December.
Understood. And because this is, sort of breakthrough technology, so could we expect better efficiencies from this particular unit versus the facilities which we have already operational?
Yeah, what I would like to highlight here is that the primary focus of installing this is to be more green and totally cut off the greenhouse emission gases. So that is the primary idea of having these modules and this technology, wherein literally imagine having a smelter wherein you walk through at room temperature into a smelting plant and there's no involvement of fire. Going forward, we also look at powering these modules by solar power and making it 100% green. And also in future, we'll be looking at if we can develop the process where we can have some carbon credits over these through these modules and all of those. So definitely in terms of efficiency and recovery, the recovery is marginally higher through this process and the wastage is lower. But I will be able to give you only absolute numbers once on the pilot scale we have got those, but on the commercial scale, like I said, by December, I'll be able to give you absolute numbers. Fair
enough. And one question regarding the procurement. I think you mentioned the ratio of 77:23 right now. So if you could just, help me out with how the cost differences in procurement internationally versus domestic, and how do you see this ratio going forward? I know you mentioned increasing domestic procurement, but if you have sort of a target ratio going forward.
Basically, when we procure international and domestically, there are different kind of grades of material that we import and we procure domestically. Domestically is predominantly only the batteries, end-of-life batteries from your telecom segment, from your IT companies or your automobiles. Wherein when we import, we also import various other kinds of lead scrap in terms of your sheeting, your old tubes, roof sheetings, and all of those. So more or less, both of these, the domestic procurement is done vis-a-vis the orders of the domestic market, where the prices are matched basis the domestic sale prices, and the import is done to match our export orders. So we try to manage the pricing basis, our order positions, and how we are placed on a supply side.
Sure. That was helpful. I'll come back if there are any additional questions. Thanks.
Thank you.
Thank you, Karan.
Thank you, Karan. The next question is from the line of Mr. Ankit Sharma. Please identify your affiliation and go ahead, Ankit.
Yeah, thank you so much. I am Ankit and I am an individual investor. I have a couple of questions for the management. See, first and foremost, I understand that there has been a reduction on the operating margin, largely because of the macroeconomic factors. So I want to understand that, does your customer contracts include any kind of a price escalation? And two, have you started having discussions with your customers on passing on the incremental cost?
Hi, Ankit. Good afternoon. So regarding your question on the price escalation, yes, definitely the price escalation started midterm after the contracts were negotiated last year in terms of your oil prices, your power fuel, and your other additive costs because of the supply chain disruption. And in this year's contracts, while negotiating, we have taken up all these points. And based on these points, we are still currently under negotiation to complete certain contracts and repricing on all of these. So what happens, we work on variable pricing mechanism where I won't say probably, we can, no contract can cover 100% of all the uncertainties because the uncertainty could be both ways. So a part of these uncertain conditions can be covered under the contract, but I would not say 100% of all these uncertainties can be covered under the contract. So at this current point, which we feel currently is the peak of the oil cycle or the freight cycle of any of it, till this point we can negotiate and get that incremental cost. But going forward from here, if again there's a huge jump, I mean, we'll have to wait for the contracts to reprice in or, look at some other way of trying to work on the costing.
Understood. So, sir, can we understand that the discussions that you have had till now, can we expect some kind of an improvement in the operating margins in the present quarter, especially since you have given a guidance of around 6.5% in terms of operating margins for FY23?
In specific in this quarter, yes, we will be in the range of our 6 to 6.5 margins that we have committed. And for this quarter, we definitely don't see any downside on those numbers.
Understood. Sir, I also have a question on the revenue numbers. So FY22, we have seen, pretty steep growth in terms of revenue. Are we expecting something similar for FY23 or would the numbers, be a little more muted in terms of revenue growth?
So, Ankit, we've already mentioned that revenue will grow for lead at a CAGR of around 20 to 25%. It may fluctuate based on, the business scenarios, how things shape up during the financial year. But then that's what the market expectations are. And obviously, since we are entering into the intent to enter into different verticals, there would be a certain growth coming in from there as well.
I'll also add on one more point here. In terms of quantum, in terms of quantity produced, definitely there will be a growth in numbers. Now, if similarly, if the basic price, that the LME or something comes to a much lower price, the realization per ton comes down, but that is a market phenomena which cannot be done. But in terms of numbers and in terms of percentage of our margins, we will stay intact and will continue to grow. Apart from which, as Piyush said, we have our other verticals, and from those other verticals also we will start pushing out numbers by Q3 and Q4. So definitely we will see all around growth.
Thank you, sir. My last question is that, presently the stock is pretty illiquid on the BSE exchange. So is the management or the board, thinking about increasing the liquidity, say in terms of share split or say, some kind of a bonus issues to the shareholders?
As Mr. Kumaravel sometime back mentioned, our board is looking into the, various obligatory requirements to be listed on the NSE. And definitely once our board has something and they are with a concrete decision, we definitely will update the shareholders as well.
Sure, sir. Thank you so much, sir. Thank you for your patience.
Thank you. Thank you very much.
Appreciate it. Thank you.
Thank you, Ankit. The next question is from Mr. Umang Shah of Sarath Capital. Umang, please go ahead.
Hi, sir. Good afternoon. Thank you for taking my question. Sir,
good afternoon, Umang.
Yeah. Good afternoon. Sir, with respect to the ACE recycling tie-up that we have, do we have any, so first question was, what is the learning curve in getting the facility to run properly? Do you require specific training? Do the people from there actually train your staff in doing that? And how difficult is it for someone else to develop this on their own?
Yes, good question, Umang. I'll reply to your questions. So basically, this is, like I said, this is a technology which nobody else is currently using. And here, during the pilot stages, when we have evaluated, we have sent a couple of our key people where we did the pilot project, and there has already been a learning curve which has been successful. And prior to finalizing and commercializing the buyout of this technology, that curve has been learnt and done. Yes, of course, once the equipment is in our premises with our people and our efficiencies, we will definitely intend to make it more efficient and, in a much leaner manner to go ahead with the production cycle and everything. And going forward to you asking if somebody else can look into this process uses a lot of proprietary chemicals and other processes, which cannot be sourced by other people unless the license holder wishes to give out their patents and their proprietary chemicals. And
right.
We have certain amount of exclusivity on the project as well. So till a couple of years, this project remains only with us currently.
Right, sir. Very useful, sir. And sir, the second question was, we are saying that we are establishing the new subsidiary Future Tech with 60% stake, right? So who would be holding the 40% stake there?
Existing promoters of Pondy Oxides, they are going to hold the balance.
Right. Got it.
And definitely also when we look into certain JVs with certain people who have the technology, maybe there could be certain partnership on stake as well with those people.
Right, sir. And how much capital are we looking to put in this subsidiary starting, since the capex will be happening from that subsidiary? Capital that we have any idea of how much we'll be putting there?
Initially, we started with a very small capital. Then, depending upon the requirement, we scale up to 1 or 2 crores.
Got it. Yeah. Thank you very much, sir. These were my questions.
Thank you, Umang. Once again, ladies and gentlemen, please use the raise hand functionality to let us know of your interest. The next question is from Mr. Vaibhav Badjatya. Please go ahead. Vaibhav, do you have a follow-up question? I see that you have raised your hand.
Yeah, hello. Can you now hear me?
Yes.
Yeah. So thanks for the follow-up. Earlier during the call, you said that domestic procurement is for kind of sale to domestic players only. So is it under any kind of back-to-back arrangement where we don't have any inventory risk? Is it like that kind of arrangement, or it's basically inventory is provided by them and we just do the job work and then sell it back to them? Is it that kind of arrangement?
No, Vaibhav. I'll classify. Let me ask you your question back and just correct me if I'm right. So you're basically asking if our domestic sales is a back-to-back arrangement where the customer provides us with the raw material and we supply back. Is that that's what your question is?
Right.
No, I'll just divide our domestic part into two.
Okay.
Wherein one part is wherein there is a direct purchase, wherein we look after our purchase of raw material or all the complete process and we supply the material. It's a sell order. Then a second part of it is where we help a few of our customers recycle their battery scrap and stuff, like few companies like Amaraja and so, which is under a job work model, wherein they provide us the raw material, we process and we sell back the finished product to them, wherein we only charge the upside of the the processing cost along with other inputs and our profitability on that. There, we don't pay anything to them for the raw material, nor do they pay for the complete finished goods. It's only the differential as per contract or whatever product is being manufactured.
Okay. So it's both the models.
Yeah, but both are totally separate. I mean, they are not interlinked.
Right. Understood. But obviously, in job work order, we don't have any price risk as such.
There's no price risk.
Right.
There's no price risk.
Okay. And in terms of so if we compare your performance to some of your competitors, there is definitely a difference in margin, either in per ton basis or percent. I think per ton is more appropriate metric. So there is definitely a difference. So would it be attributable to lower level of smelting operations that we have, or what is the difference in what can explain this difference? What kind of risk that probably other players are taking, which we are not taking, which can explain this difference?
So I think we need to here do an apple-to-apple comparison, Vaibhav. When we compare the numbers, I mean the EBITDA margins standalone for POCL versus a competitor versus a certain competitor standalone and on a consolidated basis, then we end up doing an apple-to-apple comparison where the margins actually match up. In fact, there the margins are even better for us. But when you look at a consolidated level and see the entire international segment coming in for the competitor as well, then you cannot have an apple-to-apple comparison really. But then I would like to kind of reiterate the fact that, what Ashish mentioned during his speech earlier, that we are planning to, set up scrap yards for collection for non-ferrous in the coming years to kind of get a leverage on better procurement policy and all of that. So therein we will eventually see an incremental operation margin per se. And obviously operational efficiency plays an important role for us, which we are kind of looking into since the last 3-4 months, and we will see a certain realization in the coming months also.
Right. Correct. Yeah. So just a small follow-up. So basically the competitors like Delta have the large international operations as well, and they primarily just kind of smelt it overseas and then import the smelted thing. So is that the international smelting operation have the higher margin and that's what explains their superiority, or there is something else which probably I'm not able to understand?
See, we won't be able to comment on that. See, internationally things are volatile. So we have to understand that. So if we were to kind of introspect and look at our operations right now, so we are right now based out of South. And that's a strategy which we have kind of thought about since so many years, and that is how the company has shaped up with a similar turnover. I mean, at par with the company you just named. So internationally, there are risks associated. We never know when the bubble can burst, but then it is important that we only introspect our ideas, and hence we would probably not like to comment on that.
Understood. Yeah, obviously, something better most of the time comes with increased risk, and that's what I wanted to understand. I think, yeah, that's it.
But then just to add on, we are kind of focusing on creation of yards and across geographies, so that probably will not restrict us in future.
Yeah, but we will continue to do smelting in India only, right? And yards will be just for scrap collection. I think smelting will continue to do in India only, right? We don't plan to have any smelting operations overseas.
We don't know as of now. See things, business opportunities and business, the parameters of business can change overnight. So you never know what really can happen in future.
So basically, as per market opportunities, we will definitely explore and see if it's viable. We definitely will look into other markets as well.
Okay, got it. Understand. That's it. That's it for now. Thank you.
Thank you, Vaibhav.
Thank you, Vaibhav. Ladies and gentlemen, that's all the time we have allocated for today. Please send in your follow-up questions by email to us, and we'll follow up to get those answered by POCL management. A replay of this call as well as the transcript will be made available on alphastreet.com/India a few hours from now.
RC, I'm sorry to interrupt. I think Rohit Ohri has a question. We can take that question.
Sure.
Last time, I don't think we spent too much time, so we would like to give the benefit of doubt to everyone here.
Sure.
So let's take that question.
Thank you, Piyush, for the confirmation. Rohit Ohri, please identify your affiliation and go ahead and ask your question.
This is Rohit. Am I audible?
Yes, Rohit.
Go ahead.
Hi, Ashish, KK, and Piyush. A couple of questions that are related to the new client addition. If you can take us through that. because we kind of have a dependence on 3 to 4 major players who occupy around 60 to 70% of the turnover. So any new clients added during the year or the last 2 years?
So Rohit, your question is, have we got any new clients added to our portfolio? Is what your question is in the last year?
Yes, Ashish.
Specifically, on the copper side, yes, we have some clients, one client addition, and apart from that, on the lead side, we have had some client addition in Japan and also in the Thailand market.
Okay. In terms of seasonality, which impacts the business, is that the case that happens with us as well? That the first half is slightly stronger and the second half is sluggish? Or?
So basically, what happens? I would not specifically name anybody, but the way most of the manufacturers in this industry work is they take orders more on spot basis and less where they have their order book already filled. But wherein with our company, almost 90 to 95% of whatever orders we intend to take, we sign long-term contracts. Hence, we do not have the kind of seasonality in terms of ups and downs. Yes, definitely, wherever we have an opportunity, we try to push it up more, but we do not have a lean season or a peak season specifically, as you're asking.
Okay. So my next question is, you touched upon the furnaces addition, which will happen very soon for us as well. So these furnaces, are these electric furnaces or gas-based furnaces?
So basically, for smelting in our industry, we have to use oil-fired furnaces, okay, or gas-fired furnace. These are only two options for smelting currently. So this furnace that we are, which is going live in June, the last furnace, it's an oil-fired furnace.
Okay. So will that kind of bring an uptick in the EBITDA margins that we earn?
Can you repeat that? I'm sorry, I didn't get you.
Does the addition of the furnace bring an uptick in the EBITDA margins that we earn?
The addition of this furnace helps us to increase our smelting capacity within our overall capacity. So definitely, as we go a step behind, we go in smelting. Smelting has slightly better margins than only refining.
In terms of the non-ferrous metals, which Piyush also touched upon, can you take us through any thoughts of entering into aluminium smelting, or are you looking at some yellow metals where you intend to go in the non-ferrous part of the system?
Rohit, right now on the non-ferrous segment, since all of us are aware, we are into lead, copper and zinc. And there are certain balanced materials which we intend to look into. And to answer your question, yes, we are looking into various other non-ferrous segments as well. And maybe we'll see some headway in the coming months.
So do you intend to go in for certain forward integrations related to those segments which you might enter into in the non-ferrous?
Yes, definitely.
Okay. So my last question is, what sort of discussions generally happen in the boardroom or the board meeting, which is related to the enhancement of the business or the operations, or if you can take us through what sort of discussions do you all actually have? I'm asking for a vision of next 3 years or 5 years as to what exactly.
Interesting question, because nobody still now asked us what happens inside the boardroom. So I can only as much tell you as much as everyone else can know. But okay, on a higher level, I can say currently the discussions are more on diversification and completing your product portfolios, and also looking at diverse markets, whether be it domestically or internationally. So most of the discussions are looking into that, but not with any conventional technologies, but looking into more modern technologies and all of those. So this is what is taking up most of the time in the boardroom discussion.
Okay, sir. Okay, Ashish, thank you for answering. Thank you.
Thank you, Rohit.
Thanks.
Thank you, Rohit, for your question. Once again, ladies and gentlemen, please use the raise hand functionality to let us know of your interest to ask a question. I'll just wait a couple of seconds to see if there are any more questions. Thank you. As there are no further questions, we are going ahead and closing this call. Ladies and gentlemen, if you have any follow-up questions, please do send in your questions by email to us, and we'll follow up to get those answered by the POCL management. As a reminder, a replay of this call as well as the transcript will be made available on alphastreet.com/India a few hours from now, and also on the BSE exchange. Thank you all for joining us for Pondy Oxides and Chemicals Limited Q4 FY22 earnings call. You may
all the participants.
Thank you.
Thank you, everyone.
Thank you, everybody.
Thank you, RC, for moderating the call.
Thank you, Piyush. Thank you, everyone.
Thank you,
You
RC.
may all now disconnect.